All right, good morning. We're going to go ahead and get started. Welcome to the Nebraska Public Employees Retirement System State County Pre-Retirement Seminar. My name is Rachel Stallworth, and I am one of the training specialists here at NPERS. NPERS is the acronym for the Nebraska Public Employees Retirement Systems, and you'll hear us say that a lot throughout the day so that we don't have to repeat ourselves saying the Nebraska Public Employees Retirement Systems. With me today is Matt Rudine. He is the other training specialist, as well as Heather Critchfield-Smith. She is the marketing and communications specialist, as well as the manager of the education services team here at NPERS. And all three of us, we are all very excited to be here today to talk to you about your retirement plans. We are very glad you're here as well. Now let's talk about the retirement office and how to contact us. So the Nebraska Public Employees Retirement Systems, or NPERS, is the state agency that administers both the state and the county retirement plans. And you'll want to keep this information handy. Why? Well, we have your money. And as a rule, I like to have the names, phone numbers, and addresses of the people who have my money. We're located in Lincoln at 1526 K Street, Suite 400. So we're just downtown across from the Capitol on the 4th floor. We have the call center available to you if you have questions about your account, and you can reach that locally at the 402 number on the screen or in your binders, as well as at the 800 number that's there. And we also have our fax number that you can use if you need to fax something to us. And our website is the last thing listed on that slide. It's npers.ne.gov. And you will hear us mention that website again roughly 100 more times before we're done here today, because it's just a great resource that's available to you. And we want to make sure that you know about all of the great things that are available to use and view. Regarding our office, again, we do offer office visits for our retiring plan members, and those are by appointment only. First, I do want to cover two general misconceptions regarding office visits before I go into a little more detail about them. So let's clear those misconceptions up. The first one is that you must have an office visit to retire. That is not true. Most individuals will simply call, fill out, and return their paperwork, and then bam, they're retired. It can be that easy. The second misconception is that during an office visit, they can help you decide what's best. That's also not true. No staff at NPERS is qualified to give financial advice to members. So if this is what you seek, then consulting with a financial advisor is what you need. These office visits can be done in person or virtually via Webex, so you can do them virtually just like how we're doing this webinar. And of course, you can call our call center with questions at any time. But when you schedule an office visit, it allows NPERS staff to look at your account beforehand. We can calculate estimates, create your retirement packet, and answer questions very specific to your account. So it's a really beneficial tool, these office visits. And if you do want to make an office visit, please make these requests no more than 6 months and no less than 1 month prior to your retirement. And if I was writing something down at home, that might be what I would write down, is to make these requests no more than 6 months and no less than 1 month prior to your retirement. Just that way we can have it ready to go right when you're ready to retire. So a good question to start with is, who does what? So NPERS is not the only entity that works with your retirement plan. There's also a plan record keeper, and that plan record keeper for us is Emeritus. Emeritus is responsible for tracking the balances of member accounts, distributions from your account, and sending the quarterly statements that you receive. So when you get mail from Emeritus, don't throw it away, because it's likely important information about your retirement account. If you're in a plan where you make self-directed investment changes like the DC benefit or the voluntary deferred compensation plan, both of which we'll talk in a lot more detail about later, they handle those transfers as well. But if you do have questions about your retirement benefit or your account specifically, you'll want to contact NPERS, not Emeritus. So speaking again of our beautiful website, this is what it looks like. If you haven't seen it in a while, it has gotten an update pretty recently. Within the last year and a half or so, we've gotten a complete redesign. So we're constantly updating our website with plan information for members in the form of videos, newsletters, forms, investment information, things like that. And in fact, when we're not on the road doing seminars or online doing webinars like this, we spend most of our time working on those things. As you can see here on the screen and in your binder, we also post schedules about upcoming in-person seminars and our online webinars. And you'll also find a link to our benefit estimator, which Matt will talk about in more detail a little bit later. But I just did want to cover really quickly because it's one of our really great tools that we have on our website. And essentially you put in some dates, you put in some of your information, and it'll show up some estimates of what your annuity options could be. So that's just one of the great tools that our website has. So when you visit NPERS.ne.gov, you can also find all of the forms that we're going to talk to you about today, like the beneficiary form, and most of those forms are fillable as well. So you can fill them out actually online and then print them out and sign them. So it makes it a little bit easier. Let's talk briefly here about the online account access button on our homepage. So in the top right-hand corner, you can see it says log in. And there are two separate online account accesses that are available to state and county members. And those are the NPERS online account access and the Emeritus online account access. So those are two separate logins that will lead you to two separate pages. So keep that in mind when you do go to log in. You can go to two separate areas. If you create an NPERS online account prior to retirement, you're going to be able to review the beneficiaries you have on file with NPERS. And that's important because that information isn't information that can be given out over the phone. So if that's something that you are really curious about, you want to review your beneficiaries, you can do that by creating an NPERS online account. And then the Emeritus online account access provides you with additional information about your account. It'll show you your account balances. You can access your quarterly statements online. And if you're in those retirement plans that allow you to make investment elections that we talked about earlier, you can do those online as well. So we'll talk about that a little bit later too, but you can also review your investment performance through Emeritus online account access. So those online account accesses are some really great tools that we have on our website as well. You can do things online that are things that we can't do in person, so or over the phone, and so those are really important things that you can do if you create an account. All right, so let's talk about retirement. It used to be that people thought of retirement as a three-legged stool. You had your company's pension plan or your retirement plan, your own personal savings or your investments, and you had Social Security. But over the years, people have largely stopped working at the same place for their entire careers, for whatever reason that may be. And we've grown a lot worse at saving. And whether that's due to inflation, kids being expensive, for me, it's because I have a problem with luxury iced coffee and needing to have it every morning before work. But for whatever reason, we are just having trouble saving like we used to. So what's happened is that more and more of those three-legged stools are getting smaller, and people are putting a lot of faith in Social Security. And that's a problem given that Social Security is a program that's only designed to replace 35 to 40% of your income. So when you start taking legs away from stools, your stool starts to tip over, and no one wants to sit on a stool that isn't sturdy, and retirement is the exact same way. So it's important to note that what we're talking about here is your money, money that no one else has access to. Bankruptcy and financial hardship can't touch this money. The only possible ways that someone else gets access to your pension is in the event that you run into some trouble with the IRS or a divorce. So if you keep the tax man and your spouse happy, then you don't have anything to worry about. This money is invested and available to you only when you quit or retire. It's your pension with no Social Security offset, meaning the amount of your benefit does not affect the amount of your Social Security payment, and the other way around. The amount of your Social Security payment does not affect the amount of your benefit. So with that statement in mind, as you're sitting here today thinking about retirement, it's important to think about how much you're going to need. For a lot of people, your mandatory contributions are not going to be enough. Most people will need to save more. So keep this in mind as we spend the next couple of hours talking about how your mandatory plans work, and hopefully share some possible solutions for you to do some additional saving with our optional deferred compensation plan. So on this slide, here are the different things we're going to talk about today. I'm not going to spend too much time going over them right now because we are going to spend the rest of the morning going through them, but I just want to give you a few definitions before we get started. So the first thing we're going to talk about is which benefit you're a part of. So either the cash balance benefit or the DC benefit, which stands for defined contribution. Then after we do that, we'll talk about contributions, which is just the money placed into your retirement account. After talking about the money portion of it, we'll talk about vesting. And vesting is the point at which if you were to terminate, you'd be entitled to all of your contributions plus the contributions made by your employer. Then we'll discuss investments and rate of return. After that, we'll talk about retirement or termination options. Then we'll discuss the different annuity options. And an annuity is a fixed sum of money that's paid to someone. With annuities, we'll discuss that benefit estimator, which is that tool that we have on our website, and it shows you the estimate of how much money you could possibly get with each annuity option. And lastly, we'll discuss disability, death before retirement, and finally, that voluntary deferred compensation plan. So, an important place to start is to talk about which benefit you are a participant in. So there are two different benefits that you might be a part of as a state or county employee. And those are either the defined contribution benefit or the cash balance benefit. Those are the mandatory participation benefits. And then there's also the deferred compensation plan that we mentioned just a second ago, and that's the voluntary plan, meaning you must opt in to be a member of that plan. And Heather's going to talk about that a little bit later this morning. So, which benefit are you a part of? There's a few ways you can tell. The easiest way is that if you began in the plan on or after January 1st, 2003, you are a cash balance member. Now, there are two different tiers in the cash balance benefit. If you're in cash balance and you were hired prior to January 1st, 2018, you're in tier 1. If you were hired on or after January 1st, 2018, you're in tier 2. Now, if you started with the state or county prior to January 1st, 2003, it does get a little tricky and you'll probably have to do some remembering. So if you started before January 1st, 2003, you were enrolled as a defined contribution member, but you were given three options or three chances in 2003, 2007, and 2012 to become a cash balance member. So if you joined the plan before January 1st, 2003 and did not elect to convert to cash balance benefit in 2003, 2007, or 2012, you're a defined contribution member. Another way you can tell is if you look at your statement. There's a pie chart on there that shows how your funds are invested. And if your pie chart looks like a pie fresh from the oven that hasn't been cut into yet, you're a cash balance member most of the time. If there are pieces cut out of that pie, indicating your money is spread out among different investments, you're a DC member. Now, sometimes DC members elect to keep their money in one investment, and in that case, you would be a full pie as well. But next to that pie chart, it will tell you if you're cash balance. So if you want to take a look at your summaries, or if you want to take a look at those statements, then it will tell you that as well. So we're going to spend most of the rest of my time here talking about how these benefits are different, like their rate of return or risk, their investment choices, distribution options, and annuity benefits. However, first, I want to outline the ways in which they're the same, those being their contribution rates, vesting rules, and retirement age. So one place where they're largely the same is in their contributions. So if you're a state employee here, you know that every other Wednesday you see 4.8% taken out of your salary taken to contribute to the plan. The state of Nebraska then matches at 156% of that contribution, and it's put into your retirement account. That's only slightly different from the contributions made if you're a county employee. So as a county plan member, you contribute 4.5% of your salary, and the county matches those contributions at 150%. So while the state and county rates are slightly different, the contributions are the same no matter what benefit you're a part of. So if you're a state member, it doesn't matter if you're in DC or if you're in cash balance, you will continue to contribute that 4.8%. And if you're a county member, you'll continue to contribute that 4.5%, and it doesn't matter which benefit you're a part of. Another way in which the plans are the same is in their vesting rules. So the question is, what is vesting? Well, like I said earlier, vesting is the point at which if you were to terminate, you would be entitled to your contributions plus the contributions of your employer. So if you're under the age of 55, you are vested in the plan after 3 years of contributing to the plan. So say I've been with the state for 2 years. If I were to suddenly quit tomorrow, and don't worry, Heather, I'll be in tomorrow. When I roll my retirement account into whatever I choose to roll it over to, I would only receive my contributions plus the interest that it has accrued over time. But this time next year, if I were to quit, because I will have been here for 3 years, then I would receive my contributions plus the contributions by my employer. If you're over the age of 55 and a contributing member to the plan, I have good news. You're already vested. You don't have that 3-year period to wait, but notice I said if you're a contributing member to the plan. I couldn't quit now at age 27 and just leave my money in the plan until I turn 55 and be vested. You need to be a contributing member to the plan and you're at the age of 55 or over, then you're vested. So those are the 2 easy ways to be vested. The other ways are if you die as a contributing member or develop a qualifying disability. So those are the other 2 ways to be vested. So the first 2 ways are the ways that we are NPERS approved is what we call it. So here comes the part where we talk about the biggest difference between cash balance and the defined contribution benefits. So it's in the investment options and the rate of return. So if you are a cash balance member, you do not have investment choices for your money. The Nebraska Investment Council directs cash balance funds, so they make those investment selections for you. But you do have a guaranteed rate of return. Cash balance members receive the federal midterm rate plus 1.5% or a guaranteed minimum of a 5% rate of return, whichever is greater. For example, during the first quarter of 2023, so just this year, the midterm rate was 4.25%. So add that 1.5%, which is in state statute, to that, and you get 5.77%. That was the rate of return for cash balance accounts for the first quarter this year. And this is the first time since 2008 that the rate of return was higher than the guaranteed minimum. So that's kind of cool to know. You're also eligible for dividends as a cash balance member. So you're eligible for dividends regardless of whether you're currently employed. You only need to have an account balance. So each year, the plan actuaries in June, around June, the plan actuaries review the plans that we administer. And if the plan's funded status exceeds a certain funding level, which is over 100%, they recommend to the Public Employees Retirement Board that a dividend be issued. So the dividend per state statute cannot exceed 8%, but we have come close. In 2022, so just last year, the dividend for state cash balance employees was 7.5%, and for county cash balance employees, it was 6.5%. So it was really close to that dividend per state statute, couldn't exceed that 8%. So it was very close. If those are awarded, they will show on your emeritus quarterly statements and are posted on the website. If you're still working, they may seem a little anticlimactic because they just go right into your account balance, but that's cash balance. So the question is, how is that different from the defined contribution benefit? Well, in the DC benefit, you control your own investment decisions. So there are 17 different funds available for you to direct where your contributions go. Because of this, you don't receive a guaranteed rate of return, and your account balance may decrease or increase just depending on where you choose to put it. NPERS does have investment help though, and it's available on our website, npers.ne.gov, in the form of our annual investment report and an investment education video that we worked on. So you can go see those on our website. They're available for you, and they're really great tools that are available to you. So in directing your own investments as a DC member, you make your own investment elections, allocating where your future contributions will be invested, and you can also transfer your existing balance into different funds. This is true for both your contributions and the contributions from your employer. And then you can make these fund allocations online with that emeritus account access that we talked about earlier, or with the investment election form that you can find on our website. However, I'd suggest personally using the online account access form, though, because it's a change that happens by the end of market day, as opposed to filling out a form, going out and mailing it, being subject to the post office schedule. It could take up to 2 weeks, making that a delay via the form. But that's all I have for you this morning. So it doesn't look like we have any questions in the Q&A for me. So I'm going to go ahead and pass it off to Heather now. Thank you guys for being so awesome.
Okay. Thank you, Rachel. That was great. My name is Heather Critchfield Smith, and I am the Education Service Manager. As you know, Rachel told you before, I've been with NPERS for approximately, well, we'll see, it's about 13 years as of October 1. And I really enjoy what I do. I like working here. I haven't always done training though. I started out in the mailroom. A little bit more volume, please. I hope this is a little bit better. Um, Try and speak up a little bit. Uh, yeah, so been here for about 13 years, started in the mailroom. I also did data services, which is basically they enter in your direct deposits, your taxes, things like that. Also, then I went to processing. So I have processed annuity payments. I have processed deaths. I have worked accounts. So I have kind of a unique perspective on how things run through our agency. Okay. And with that said, hopefully I can, impart to you some of that perspective. Um, because retirement, it's not a simple thing. We like to think, oh, it's a great simple thing, but for some people, it's a big process. And so we want to try and make that as easy as possible. With all the experience I have, I do have to tell you once more, I am not a financial planner. So I cannot advise you to do anything with your money. Okay. I don't have the certifications nor the education to do so. Those people get paid a certain amount because they're good at that. So just if you hear anything today that sounds like advice, it's not. Okay. So with that said, I've seen a lot of really successful retirements, and I have seen some retirements crash and burn pretty quickly. I want to impart to you the two things that I normally see successful retirees having. Okay. Number one, ready? A basic understanding of investments or an investment strategy. When you prepare for retirement, there are sometimes you don't even think about that, and you're like, okay, I'm going to come to a retirement seminar. I'm going to retire. Nowadays, you have to have some kind of understanding of how investments work. Kind of what a rate of return is, how that affects you, um, your time horizon. Now, time horizon is how long you're going to have until you need that money. The longer your time horizon is, that's further away, okay? But if you understand that, then you can establish your risk tolerance, which is how much risk you're comfortable with. Some people you have to put out a certain amount of risk in order to get a certain amount of return. And so, understanding these concepts is something that's very important going in, all right? If you don't, it is never too late to learn this stuff, okay? I'm going to stress that because when I got this job, I didn't want to know about investing. I didn't. It's boring. But we make it pretty easy for you. If you go to that investment info page that we have on our website, and I'll say the website with me one more time, guys. It's npers.ne.gov. Okay, and Matt put it in the chat for you so you can click on it anytime you want to. But the investment info page has, 2 videos on it. One for financial planning, which is kind of a beginner's video, and another that goes through with a financial planner the funds that we have available for investing. Okay. And I know you're saying, Heather, I am a cash balance member. What do I care about investments? The Nebraska Investment Council does all my investing for me. Well, I'm going to give you an opportunity a little later today that if you want to become involved in investing, you can do that too through our deferred compensation plan. Okay. Never too late. Even if you're real close, never too late to learn about this stuff, okay? And it's also never too early. I know that we have some younger members on the call today, and I'm terribly excited about that. Becoming enthused about financial knowledgeability is important to me. So, hooray. Investment strategy, number 1. Number 2, people who are successful in retirement go in with a tax strategy, okay? This can be as basic as simply understanding when payments coming to you in retirement are going to be taxed. Okay? Because if you know this, then you can plan for that. And the name of the retirement game, guys, is keeping more of your money in your own pocket. Okay? By understanding when things are going to be taxed, we can hopefully do that at a more advantageous time so that we keep more of our funds. Okay. And this, I'm going to help you with that. Like, I'm not a tax planner or a tax pro, but if I know something about taxation, I'm going to tell you. And we're going to go through all the options, distribution options, things like that. I will explain how these things are taxed. Okay. But if you watch this and you don't understand it, you can give a call to the call center, or I would actually probably send you to a tax specialist, like a CPA or a tax advisor, okay, an accountant, something like that, if you want to apply things to your more personal financial situation, which most people will, okay? So with that said, what you have, your mandatory state or county plan, whether your DC or cash balance, is a 401A. I'm going to repeat that again. And if you're writing things down at home, this is something I would write down. 401A, as in apple. It's a government pension, okay? It's different than when we talk about things like 401Ks, as in kangaroo. Different rules apply to this plan. And there are lots of different rules that apply to this plan. The IRS has rules about what we can do with retirement funds. We follow federal legislation. We've got state statutes, rules and regs. There's a lot of rules to follow with this plan, okay? But if I wanted to, get off this call and I forget something and later I'd like to research it, then I can type in, what can I do with a 401A, okay? Knowing that that's the IRS coding for the rules that apply, okay? So there you go. Now, let's have a basic understanding of this 401A. A very basic understanding of this is You have pre-tax funds, contributions that come out of your paycheck. And you know, they come out of your check every 2 weeks or whatever. Your employer matches the funds that come out are pre-tax, meaning they have not been taxed at that point in time. Okay. They go into your retirement account. Hopefully there's some growth there. And then when payments come to you from this account, they are taxed at that point in time. Okay. So anytime cash comes to you from this account, way, shape, or form, whatever it is, it's going to be taxed. Okay. Okay. Now that we have that established, let's delve a little further into the tax things that we're going to talk about. So basically, what we're going to talk about first is an RMD. An RMD is a required minimum distribution. Okay. What it is at its very basic level is it's the government taking a look at your beautiful pre-tax retirement plan and saying that if you have not taken a distribution by a certain age from that account, they're going to require you to. And the reason they do that is because they want taxes from that distribution. Okay. They say, hey, this has been growing tax-free for a real long time. We're going to tell you by a certain age, if you haven't taken your money, we're going to make you so that we can have taxes from some of those distributions you're supposed to have. Okay. Now, we put a chart up here. If you know your date of birth, you should be able to establish what your RMD age is. Okay, so just have a look at that. Taking your RMD on time is an important thing. But now I have to tell you that the IRS has one golden rule about this account, okay? And kind of retirement accounts in general. And that one golden rule is you cannot take funds from a 401A from our plan until you cease employment. Okay? So I know you're looking at this table and you're thinking to yourself, you got somebody in your office who is working way past their RMD age. And this happens all the time. We have a lot of dedicated employees, both of the county and the state, who do work past their RMD age. This is not a big deal because remember, you can't access the funds in your account till you cease employment. Okay. But it does mean that if you're working past your RMD age, and then you do cease employment, you're kind of on a fast track timeline to take your money. And if you miss your deadline, there's a penalty because, of course, there's always a penalty. With RMDs, the penalty is something like this. You ready? I want you to think about your account balance. You got your number? Now think about what 3 to 5% of that account balance is. Because as a kind of rule of thumb, you know, just a general estimate, that's what an RMD amount's going to be, approximately 3 to 5%. Now, I've seen them higher than 5%. Yeah, I've seen them less than 3% sometimes, but it's a good rule of thumb. So that 3 to 5% of your entire account balance would approximately be what an RMD is going to be. Now, if you missed your deadline for taking it on time, what happens is 25% of your 3 to 5% is gone immediately, like that, as a penalty. And that's not keeping more of your money in your pocket. Okay. So we want to make sure that everybody understands what the constraints of RMDs are. Now, most of the time, this is not going to affect a huge amount of people. Most of the time, people will have retired way before their RMD age and taken their account. So you don't even have to worry about this. Okay. But if you are working up to your required minimum distribution, or you intend to leave your account until that point in time, it's important to understand what the timelines are so that you don't miss them and what the rules are for that. We try and make this easy, so we have a handout, and Matt has just put that into the chat. So if you have, time, take a look at this until you understand your RMDs. Okay. If you have questions, another one of those things, you can call a call center, or if you have questions now about this, you can put them in the chat. Not in the chat, I'm sorry, in the Q&A box, please. This is going to be important or more important to people who have cash balance accounts, okay? And we're going to get into the reason why for that in just a minute, all right? But that's RMDs. So I told you the IRS's golden rule, right, for taking money out of your retirement account. And that is that you have to cease employment in order to do that. We're going to come around to that topic again. But when you cease employment has different terminologies with our office, okay? So it depends on when you do that your term's a little different. If you terminate employment, if you cease employment on or after age 55, then we consider that a retirement, okay? So we call that a retirement. If you cease employment prior to age 55, we call that a termination. Now, a lot of people, I've had several people at seminars and things like that were like, Heather, I don't like saying termination. That sounds terrible. It's weird. And this has no connotations to us in the office, okay? We don't care if you got fired, if you quit, what happened with it. It's just important to us that you ceased employment, okay? That's the only thing. And with that retirement terminology, it has some effect on continuation of health insurance if you're a state employee, so that's why we mention it. But the termination one, so if you're under 55 and you cease employment, this means that you could be subject to something big, which is the early withdrawal tax penalty. And we don't talk about this huge amount, but it's important to know that it's there, because if you take a lump sum, you've terminated, you try and access funds from your account, and you attempt to take money from your retirement account, and you have ceased employment prior to age 55, and you are subject to this penalty, then what happens is we have to mandatorily withhold 20 and 5 from your lump sum. That's just how we do lump sums, okay? That's across the board for everybody. 20 and 5 is what's withheld from those distributions. 20% federal taxation and 5% state. But if you're subject to the early withdrawal tax penalty, then at the end of the year, when you go to square up with the IRS, they're going to essentially, you have another 13% in taxation that you're going to have to pay. And that's 10% federal and 3% state on top of the 20 and 5. Okay, so it's just important to note that if you have terminated employment and then you go to access funds, 38% of that to taxation. It's a big, hefty taxation on that. Now, will you get that back? I don't know. I don't know what tax bracket you're actually in, and that will really make the difference on that one. But you could be subject to that early withdrawal tax penalty, and it is no joke. Okay. Basically, even if you retire or terminate, important to note that you have the same distribution options, regardless of what age you cease employment. This is just about ceasing employment and when you did it. Okay. So now that we've ceased employment, we can actually access funds from our account. Okay. And this is the important one where you need to know if you are DC, defined contribution, or if you are cash balance. Because the rest of this whole presentation is going to be divided up because you have different distribution options. If you're a defined contribution participant, then your distribution options are not the same as cash balance distribution options. That's why we try and go through it so people know. If you don't, you want to make sure that you find one of your statements and you have a look at it, or you call the call center and you ask, okay? Because it's important. If you're a DC participant, your distribution options go like this. You can defer it, which means you just leave it here. You can take a lump sum distribution, that's cash to you. You can do a rollover, which means that you roll money out of your account to another retirement account someplace else. You can do a systematic withdrawal, which is simply a series of small payments, or you can do a monthly annuity, or you can do a combination of all of these. Okay. The most important part of this slide, though, is the one that I didn't read verbatim, and that is if you are defined contribution, there's no limit to the number of distributions you can take, except for, of course, your account balance. Okay. What does that really mean to you? Well, it means DC participants can take partials. Okay. So essentially, if you wanted to and you were DC, you could defer your money, which means you cease employment, but you leave the funds in your account. Okay. You could leave them all the way up to your RMD age. Okay. When you're required to take a distribution. And then because you can take a partial, you could get online to one of the great online RMD calculators that are available. Calculate using your account balance what your exact RMD distribution amount should be. You could put that on your application and then take a lump sum for that RMD amount and then leave the rest. So next year you would come back and take your subsequent RMDs. And, once you start, if you have a balance, you have to keep taking subsequent RMDs. But you can do that because with DC, you can take partials, okay? But I stress that because the next ones we're going to talk about are cash balance distribution options. And if you are a cash balance, you cannot take partials because cash balance has what we call a one-time distribution event. And what that means is that when you take $1 out of a cash balance account, you have to take all the dollars out. Okay? So you still have many of the same distribution options that you can do if you're cash balance. You could take a monthly annuity. You could do a lump sum. You could do a rollover, roll your money out to another place. You can do a combination of all of these. But it has to all occur at one point in time. I'm also going to say that you can defer your account, which means that you can leave it, like my last example. If you're cash balance and you leave it, you can do that all the way up until your RMD age. But this is why this is important, okay? Because I just said cash balance is a one-time distribution event, didn't I? So if you leave it all the way up to your RMD age and then become required to take a distribution, you are then required to take out all your money. Okay? So also not a big deal, but it'll trigger your one-time distribution event. Okay? That's important to note. And that when it happens, you have to take all your funds out. So you simply better know what you want to do with your whole account at that time. Okay? Now, this is kind of a tough one for people to wrap their minds around. So I like to do a numbers example on this one. Numbers kind of help me understand concepts a little bit better, and sometimes for other people too. So let's say that I am actually a cash balance tier 1, and I am, okay? And I have $60,000 in my account, okay? And I have ceased employment. So let's say I retired, and with that $60,000, I'm going to do 3 things. Okay. I'm going to, let's say, take a $10,000 distribution. When I say distribution, I mean lump sum distribution, cash to me. And you're like, Heather, why would you do that? Well, probably because recently I read a study that came out of the Boston Center for Retirement Research. And yes, that's a real place. And they came out with a study that said about 60% of American retirees are not prepared for something they call a financial shock. And what do you think a financial shock is? Well, it's when the tree falls on your roof, okay? It's when you drop the engine in your car because you drag racing on the interstate again, okay? It's an emergency. And what they said in this study was that most people don't have access in retirement to a liquid cash account that will help with emergencies. Sometimes people get real good at setting up income streams, right? And if you set up an income stream, that's like Social Security, or if you were to take an annuity from us, where you're getting a payment monthly, and you know what that payment's going to be, but you're getting it monthly, okay? That's an income stream. And if you set up all the funds coming to you in an income stream, what happens if there's an emergency? Okay, now I know in retirement, I would not be prepared for that. So I'm willing to take the 20 and 10 or 20 and 5 tax hit on that distribution amount of $10,000 so that I can put that into an emergency account for my retirement, just in case something happens. The water heater breaks. I mean, Lord knows the minute you go, something's going to happen. But it's important to have an emergency account, some liquid cash that you have access to. So for me, $10,000. The next thing I'm going to do is I'm going to roll out about $25,000. Okay. I'm going to roll that to my Edward Jones, Raymond James, Charles Schwab, Vanguard Fidelity account. Okay. And just roll that to that. You can do that. And then I'm going to take the remaining $25,000 in my account and I'm going to purchase an annuity with that. Okay. So I've done all the distribution options, but I'm doing them at one point in time. 10,000 lump sum, $25,000 rollover, $25,000 purchase of an annuity. Okay. That's my whole account balance, my whole $60,000. So that's kind of how the one-time distribution event works. Okay. If you take $1 out, you take all the dollars. All right. Now, we're going to briefly go through all of the distribution options one more time, okay? So if you have questions about and just specific ones, we'll get to that. Deferral. This is the one where you just leave it alone. I know that I worked for a private company at one point in time, and when I left, they told me that I had to take my whole account, my retirement account with me. They were like, okay, you're leaving, take this account, enjoy it. I did not do the smart thing and roll it into something else. I spent it all. But NPERS is not that type of entity, okay? If you cease employment, you can leave it. You can just leave your account. You can leave it up to RMDH, okay? And if you're, DC, you can leave it up to RMDH, take your partial RMD and, still leave it. But there's a lot of good reasons for leaving that account, okay? If you're DC, one of the best reasons for leaving it is the fact that it's invested the way you want it to be invested, okay? If you have a strategy that you're applying to your mandatory account, great. You can continue that strategy. If you're not, working for the state or county, you can still change the funds that you're invested in, okay, using the Emeritus Online account. And I think that's a great idea. It's still making you market returns. So that's a great a reason to just leave it. If you're cash balance, then one of the great reasons to leave it is you are having the 5% guaranteed minimum. And I can tell you when the market doesn't look good, that minimum looks great. But I'll also tell you something kind of fun. This year, the rate of return for cash balance has been consistently above 5%. And we were excited to see that in the first quarter because it was the first time it had happened since 2008. But then it continued for each quarter. So this whole year, like our average rate of return is actually above 5%. It's 5.63. And that's kind of nice to see. Now, also, if your cash balance, then another good reason to leave it is the fact that you are still eligible for dividends, even if you're not employed. Okay, as long as you have an account balance, you are eligible for dividends if they're awarded. Okay, so do nothing, leave it there, still making a rate of return, still eligible for dividends, even if you're not employed with the state or county anymore. And the last reason for just kind of leaving it, and this one, kind of a no-brainer. The money that you put in there is pre-tax, so it's simply sitting there, hopefully making some growth. All right. But what it's not doing is incurring taxation, because you don't incur taxation until you take funds, right? So if it's just sitting there, no taxes are happening. All right. So there you go. Reasons to defer. Lump sum distributions. We've already talked about this a little bit as far as like why you might take a lump sum distribution. You can take a lump sum to satisfy your RMD amount, particularly if you're DC. If you get up to your RMDH and your cash balance, then you want to make sure you're satisfying your RMD amount when you do all your distribution needs. This one is still taxed at 20 and 5. That's just kind of a deposit on your taxes. You may get that back at the end of the year. I don't know what bracket you're in, so I can't accurately tell you if you will or not, but it's kind of a deposit on your taxes. All right. This is kind of one that if you, when you're filling this out and you decide to take a distribution, if you live in another state and you are exempt from state taxes, then you might want to fill out the W-4N form. W-4N, you can put on there that you're exempt, submit that with your documentation, and we won't withhold state taxes from that, okay? Or if you would like to have above the normal amount of taxation withheld, you can do that. You need to fill out the W-4R, okay? Rollover. I'm going to talk about rollovers briefly. Essentially, this is the part of the presentation where I also talk about IRAs. Now, NPERS does not service or administer any IRAs, but they are great things. I think if you're saving anything for retirement, literally, you pick up a $5 bill and put it in a jar, I am super proud of you. Good job. But IRAs are great vehicles, okay? Traditional IRA functions a lot the same way that our account functions. It is pre-tax funds into an account. There's growth. So when it's coming to you in retirement, it's taxed at that point in time. But I'm going to stop you and have you think about something. Are you going to be making what you're making now in retirement? Well, the answer is probably not. Most of us will be making less. So sometimes it's okay to be taxed on payments in retirement because we're going to be making less at that point. We'll be in a lower bracket. So maybe it's okay because maybe it will help us keep more of our money in our own pocket. Okay. The next one we're going to talk about is a Roth IRA. And these are kind of hardcore marketed to younger people. But I think they're great too. However, it's important to know that with a Roth, it functions exactly the opposite way than a traditional or our plan, which is the money that comes into a Roth is post-tax, meaning it's already been taxed when it goes into the account. Okay. And then there's some growth. And then when payments come to you in retirement, they're what? That's right, they're tax-free because they've, been taxed when they went in. Okay. Which is why people really like that. Oh, I tax-free payments in retirement. That sounds great. And sure, If it's part of your tax strategy to do that, maybe kind of balance tax-free and taxed payments at that point, that's great. But I do have to tell you that that makes for kind of a special situation if people are trying to roll funds from our account, from your mandatory account, into a Roth. Because what happens is that money, if you move it from our account, remember, as all pre-tax, becomes taxable immediately. Okay? You create what we call a taxable event should you move that into something like a Roth. Now, that's not a bad thing. It's not a bad thing at all, but you have to be aware that that is happening. I've gotten calls from people, you know, two weeks after processing an application for them, and they go, wait a minute, I had no idea that this was going to become taxable. And in the worst case scenario, what happens is you roll like $500,000 from our account into, you know, something like a Roth, becomes taxable immediately, bumps you into the next bracket, and you lose more of that. Okay? That's not what we want to have happen. So please be aware of the type of money that your new accounts are. When you roll things into new accounts, what type of money is okay to put in there? Okay? That's just a smart thing. Another thing, when I talk about rollovers, most of the time you're going to be working with a financial, representative, a financial planner of some sort. I think financial planners are great, but you have to make sure that your goals and the goals of that financial planner align, okay? NPERS employees are fiduciaries of the plan. Your financial planner should be a fiduciary as well. It just means that they have your best interests at heart, okay? I am personally invested in you succeeding at retirement, okay? And that's important. It's an important thing. Also, it is your responsibility to understand the fee structures of the type of financial vehicles that you're being put into, because nothing will eat up a retirement account faster than being in something with high fees that you have no idea about. We're pretty upfront about our fees. We have to tell the legislature about them. So we have an annual report that we publish, but they're also there for you to see. Every time you get an emeritus statement, there's a box that says fees that discloses, administrative fees. It discloses, investment fees. I'm going to tell you, if you know something about investing, the basis point fees for our administration of this plan went down this year, and they went down pretty hardcore. It was such a big change. It's on the front page of our website because we wanted people to know about that. It's a great thing for you. It saves you money. So kind of a cool thing, but an important thing to note. Okay. Now, it is the top of the hour. I know that we have been talking at you for an hour now. So let's take a little break. Okay. Okay. Welcome back. We're just going to keep on trucking here, talking about our different distribution options. But this one that we're going to discuss now is called the systematic withdrawal. And this is one of the differences because it's for DC members only. So all of my DC people on the call, pay attention to this one. This is for you only, okay? And the reason is because of the nature of it and the fact that it really is kind of just a bunch of little partials, okay? Essentially, it's you telling us how much you want, okay? And it's got to be above $100, and then you're going to tell us the frequency that you'd like that payment. Do you want it monthly? Do you want it quarterly, semi-annually, annually? Up to you on that one. And basically, you can do that. You can take this systematic withdrawal all the way until your account balance rolls out or runs out if you want to. Okay, I've totally seen that happen. However, because these are really just a series of small partial refunds, they are taxed at 20 and 5, every single payment. Okay, so most people, because they're naming the amount, they can compensate for that taxation by asking for like 25% more than what they really want. Okay. But there you are. That is a systematic withdrawal. And the reason that I have it right there is because the next thing that we're going to talk about is a monthly annuity. Okay. And essentially, that is us telling you how much we're going to pay. And there is one frequency, and it is monthly. Okay. But I really want to clarify this. People have a much better understanding about Social Security than they have any other income stream. Okay, they realize that that will pay them a check, for their life once they take that. Okay, uh, but it's hard for them to understand other annuity products. Okay, with the annuities that we offer, the annuity options, essentially what that is, it's you taking a certain amount of money from your account, and some people use their whole account to purchase an annuity. Some people use half of it. I know in my example for cash balance, I used 25,000, but I also used, 25,000 on a rollover, and I took a lump sum. Any amount, but you have to think about your account kind of like your wallet. You take your wallet into a store, you look around, you find what you want, you purchase it. So you take money from your wallet to purchase something else. And that's what you're doing. You're purchasing something else. And what you're purchasing is our promise that we're going to pay you for said specified amount of time, said specified amount of money. Okay. Um, and because I get a lot of people that are like, Heather, is my rate of return going to be enough that this is going to last? No. Once you purchase this, you've purchased that promise. It doesn't have a rate of return anymore because it's not your account anymore. You've used your account, your wallet, to purchase something else. Okay. Now, this slide right here seems pretty complex. It's very wordy. It's got a bunch of stuff on here. And that's what it is. This is just a bunch of things that we use in order to calculate a monthly benefit. Now, do I expect you to take a look at this and understand every single aspect of it? No, I don't. But NPERS doesn't either. We know that, calculations for annuities are complex, okay, and they are. So we made it easy by making a benefit estimator for you. So all you have to do is plug in a couple pieces of information to that. You don't even have to log in, okay? We don't even keep track of that information. Literally, any Joe Schmo off the street can get onto our website and use that benefit estimator, okay? So you should definitely be doing that at really any point that you want. I had actually somebody who asked me when was the best time to use it. And I was like, well, I use it when my boss makes me mad. So, you just be real obvious. When I think my termination date is tomorrow. But totally up to you. We make it very easy for you to access this, okay? However, for fun, take a look at all these different factors that we use when we calculate an annuity, benefit for you. We look at your account balance, how much you use to purchase that annuity, okay? We look at if you're tier one or tier two, there are different mortality tables for cash balance, okay? Another thing is that there's a factor rate, okay? And the factor rate, what that really means in plain language, the higher that factor rate is for you, the less money you have to spend from your account to get more of a monthly benefit. Okay, pretty simple. That cash balance tier one, that rate is 7.75. It's a pretty good rate, and I'm going to show you some numbers in a couple different slides coming up, so you don't have to, keep it in your mind. But remember, the higher that rate is, the less money you have to use from your account to get a better benefit. Yeah. Now, right now, tier two is 7.2%. That is going down, okay? It's going to be 7.1% next year, and in 25, it's going to go down to 7%. That's based on an actuarial study that was done, what was it, 2 or 3 years ago? When they make suggestions about changes we should make, we put them out there in newsletters and stuff like that so you can see them. 7's still a pretty good rate, okay? Now, rates for DC annuities, they fluctuate every year, okay? When you if you are a DC member and you decide to take an annuity, that rate is what is the Pension Benefit Guarantee Company rate plus 0.75%. And we get that in January. Okay. That January rate applies to any DC member that's going to take an annuity through the whole year. So the rate that we got in January of this year applies to anybody taking an annuity benefit until December. Okay. So this year it is 5.61, and I can't even tell you how exactly excited I was that I'd be able to tell people during the state and county seminars about that. And the reason I was excited about it is because I know what the rate was last year and the year before that, and essentially it, 5.61. I was really happy to see that. So the next thing we're going to talk about is the fact that, those rates are locked in. It's not like it's going to change. These are used in the initial calculation of your benefit amount, okay? So it's not something you have to worry about. Does this fluctuate? It's the rate we use when we calculate your annuity benefit initially. We use it at that point in time. You don't have to worry about it after that, okay? When you establish an effective date, and the effective date is the date that you want to get paid, okay? When you establish that effective date, you have to do 3 things to do that. And I'm going to lay them out for you. And this is another one of those things that if I were writing it down, might be good. You have to be vested. Invested in your plan, okay? You have to cease employment. And then third, you have to get your completed, correct application into NPERS. And once you have done those 3 things, the first of the month following that is your effective date. Now, that's an important date, okay? Not just because it's a date you're going to get paid, it's an important date for you because at that point in time, you are locked in. If you've chosen an annuity option, you're locked into that, okay? This is not something you can come back 5 months down the road and be like, I don't really like an annuity. Can I buy money back? No, you can't. What you're signing when you sign your retirement application is a financial contract, okay? It's important that you know that you recognize that, and that you understand this document when you put your signature on it, okay? And that's for your peace of mind, but it helps everybody. Another thing we talk about when we talk about the COLA, the annuities, is a COLA. What's a COLA, guys? It's a cost of living adjustment. We've heard that one before. But our COLA is very different than, say, Social Security's COLA. And Social Security's COLA is determined using the CPIW, which is it's Consumer Price Index for urban wage earners and clerical workers. But our COLA, you decide if you want that at the very beginning when you get your application, okay? And if you decide that you do want a COLA, it's 2.5%. And that 2.5%, that's your monthly amount going to go up by 2.5% every single year. It stair steps up, okay? If you decide that you want an annuity without a COLA, you can also do that. Now, the annuities without the COLA start higher, okay? Their monthly amount is going to be higher, but that's a static number then that continues for the entire life of the annuity. With the COLAs on the annuity, it goes up that 2.5% every year. In fact, I had somebody in the webinar yesterday who said, Heather, why do you even talk about annuities without a COLA on them? Well, I tell you what, the without COLA annuities, people know exactly what they're getting, exactly that same amount. They can count on that, okay? And some people, they want that. They want that peace of mind. There's a break-even point when that, with COLA annuity, even though it starts lower, going up 2.5%, will eventually overcome the static number for the without COLA annuity. Okay? Now, that number varies most of the time. I mean, I've heard it, the person in particular was like, it's going to take 12 years for my, if I get a with COLA annuity to overcome the monthly amount for the not with COLA annuity. And I said, okay, well, tell me how long that you're going to live, and then I can pick you out the perfect option. And that is the thing. So let's see. We have a lot of annuity options that you can pick from. So we're going to go through these right now. One of the factors in that monthly amount is going to be which option you want. So we're going to go through every single thing that's available to you. Now, I'm just going to tell you up front, NPERS is a nonprofit. So I don't make one more dollar whether you take an annuity or whether you don't. Okay? I don't. So when I talk with people about these, they say, "Oh, you sound a little salesman." It's up to you what's going to be good for you, and I always try and really stress that to people. Okay, so this is going to be your chance to apply some of these to your life and say, okay, maybe this is what I want to think about. Maybe this is going to be appropriate for my financial situation and my family. That's what you should be looking at now if you want to establish an income stream, which is what an annuity does. Okay. Now, with the annuity options, I really enjoy talking about life only the best because it's simple. Okay. But I want to stress something before I even get into this. Are you ready for it? Everything that I'm about to talk about, from life only, the top one, all the way down to non-spousal joint and survivor, and every single bullet point in between there will pay you, the member, a check every month for the rest of your life. Okay? Every single one, from life only all the way down to non-spousal joint survivor, pays you, the member, a check every month for the rest of your life. So I'm sure that what you're saying is, well, Heather, if they all do that, what's the difference? Well, I'm glad you asked. The difference is there a death benefit to be paid? And how's that paid out? Okay. So let's talk about that. And right now, I'm going to tell you that last bullet point option, the designated period, I want you to put that out of your mind. We'll talk about that at the very end, but put it out of your mind for now. Okay. So let's talk life only. Life only is an option that it's one of those things that is what it says it is on the tin. Okay. It is a payment for your life only. With this option, there is no death benefit, okay, for your life only. You don't even get to put down a beneficiary if this is the option that you pick. There's zero probability. We don't pay a death benefit on this one. However, it's important to note, like I said, we don't financial plan for people, but I have seen scenarios in which this is the best option for people. People who are not carrying a lot of debt into retirement, this is a good option for them. Because you don't care about a death benefit if you've got nothing to pay off, do you? Then maybe you're taking care of your family or kids, leaving them money through life insurance. because you know that in the state of Nebraska, it's one of the only even slightly tax advantaged ways to do that. That's a wink, wink, nudge, nudge. Maybe you need the highest amount monthly. Life only is almost always going to be the highest amount monthly you can get because there is no death benefit associated with it. So that's kind of life only. Now, with that said, sometimes we have a scenario play out like this, where someone, they establish an effective date by doing the 3 things that they're supposed to do, which means that they're vested in the plan, they cease employment, and they get their completed application into us, and they purchase a life-only annuity, okay? And let's say they use their whole account balance to do it. They use their whole account, they purchase a life-only annuity. And they're enjoying retirement. Let's say it's the second month, and they're going to go out to the mailbox to get that payment because they have plans for this payment. Perhaps they are going to take that check straight to the old bait shop, and then they're going to stay at the lake and they're going to fish that thing dry. Enjoy a happy retirement like that. I certainly hope I do. But perhaps as you're getting that check out of the mailbox, they're not paying attention. They're not paying attention to their surroundings because they're very excited, and you know how close that mailbox is to the road. And maybe at that point in time, this person, they get hit by well, in the school seminars, we say school bus. But a couple of these in-persons we did this year, I've heard other things like truck or snowplow. Either way, you're toast. You're done. You used your entire account balance to purchase the life-only annuity, but you only got 2 payments, 2 monthly payments. Retirement planning is probability planning, okay? We're trying to simply determine how long we're going to live and how much money we need to do that comfortably. But with that said, we all know some of us could be on the wrong side of probability, okay? And I've had people come up to me and say, Heather, this scenario that you're talking about happened to somebody I know. Don't you think that's terrible? I'm not really allowed to have an opinion about this kind of thing, but it's sad. I know it's sad, but it can happen. It can happen. If that's the kind, and moreover, people go, Heather, what happened to this person's money? If they paid their whole account balance in and only got 2 payments, what happened to their money? Did the state just take it? Did you pocket it? No, sadly. What happens when you purchase an annuity is the fact that all of that money from everybody else that's purchasing their annuity and their contributions and the employer match goes into a big bucket, okay? And that big bucket of money is invested institutionally on behalf of our members by the Nebraska Investment Council, who has had a long-running, very sound financial plan that helps them make investment decisions to keep this plan well funded. Okay. And that big bucket, that's the money bucket that the actuarials actually take a look into once a year to determine if we get a dividend, to determine if they're going to make that recommendation to the board, to determine how well funded our plan is. Okay. And people say, well, are you worried about it since we didn't get a dividend this last year? Yeah, 2023, we did not get a dividend. But it doesn't mean the plan is in trouble by any means. We just have to be above a certain level of funding for a dividend to be issued. Okay, so that level is above 100%. For state plan, the funding for that plan this year is 100.23%. And for county, the funding on that plan is 100.86%. So I'm not worried. Okay. We've been in the top 10 for funding for a very long time, and I think we will continue to be. But that's what happens to that money. Okay. Everybody who is getting an annuity then can say thank you to you. Person who was on the wrong end of the stick for probability. It happens like that. Okay. If that scenario is something that super bothers you, that's going to keep you awake at night, worried about it, you might want to consider the modified cash refund instead. Okay. Modified cash refund option simply ensures that you're going to get out of this plan at least what you put into it. Okay. And how it does that is very simple. When you establish your effective date, and I swear this is the last time I'll do it, by meeting those three things, which of course is, come on guys, you're vested, you've ceased employment, and you've gotten your completed correct application into NPERS, first of the month following. Okay? Now, when you do that, you're going to spend a certain amount on that annuity, aren't you? Could be your whole balance, but it could be part of your balance. When you do that, we keep track of that number. Okay? And then you're going to start enjoying your retirement. So you start getting payments. And we keep track of that. And when you pass away, we look at that first number, what you paid, and then we subtract from it what you got in benefit payments. And if there's anything left, that's paid to your beneficiary designated on file. Okay, let's do an example of this one. Let's say I have $60,000 that I use to purchase my modified cash refund annuity. So $60,000 to start. And then let's say that I received $10,000 in benefit payments. How much is going to go to my beneficiary designated on file? Well, 50,000, right? 60,000 minus 10,000 equals 50,000. Okay, that's how the modified cash refund works. Now, sometimes this can happen where I pay $60,000 in to get my annuity option, and then I receive $120,000 in benefit payments. Would there be anything to pay to my beneficiary designated on file if I passed away at that point? No, because I've overcome that initial amount. Like I'm guaranteed to get out of the plan at least what I put into it. Okay? But I also received $120,000 in benefit payments. Not too shabby, huh? Okay. The next one we're going to talk about is the period certain and continuous option. With this one, if you pick one of these, you get to pick your certain period. Okay. Now the certain period on this one, you can pick either 5, 10, or 15 years. But I don't want you to think about them in terms of 5, 10, or 15 years. I want you to think about them in terms of monthly payments. How many monthly payments are in 5 years? Well, there's 60 monthly payments, okay? That means 120 monthly payments in 10 years and 180 monthly payments in 15 years, okay? So that certain period begins right when I get my first benefit payment. Okay, that same month I get my first benefit payment, I start my certain period. And if I pass away during my certain period that I picked, the remaining monthly payments in that period get paid to my beneficiary designated on file. Okay, so let's do an example. Let's say I've got my 5-year, okay, start when I start, and I get 48 monthly payments, and then I pass away. How many monthly payments would go to my beneficiary designated on file? 12. The last year of payments. Monthly, they would go to my beneficiaries. And to get even more into the weeds on this example, let's say that my monthly benefit, that what I'm getting per month, is $900. And I have 3 beneficiaries. Three. And that means that each one of those beneficiaries is going to get $300 a month for the last year of payments. Okay? And that's how the period, certain, and continuous works. It's important to note that with that, sometimes the scenario plays out where it's you pick a certain period, let's say 5-year period, so your 60 monthly payments, and then you receive 110 payments and pass away. At that point in time, would there be any payments to pay your beneficiaries designated on file? No, because you're outside of your certain period that you picked that we're going to pay a death benefit. Okay. And some people, they're like, Heather, what if you get 61 payments? Like you have a 5-year, you get 61 monthly payments. So it's 5 years and 1 month. If it's 61, there are no payments to go to your beneficiary designated on file. But it can also happen like this. I know somebody that made a great goal when they picked out their annuity option. And I'm going to tell you, most people who make a goal and then try and have this plan kind of satisfy that financial goal are way happier with it. They went into retirement with some debt. Okay. They had 15 years left to pay on their mortgage when they retired. And it was real important to them that that mortgage be paid off. So what they did was look at the monthly amount for the 15-year and say, okay, that satisfies it. So if something were to happen to me, my beneficiaries would get that monthly payment that would satisfy the mortgage. Okay. So this person paid the mortgage off themselves. They made it the 15 years that were the period during which we'd pay a death benefit. But then they lived 13 years past and were receiving a benefit check literally age 98, 28 years after they started. And that's it's my grandma. That's why I get to tell you the story. But that's how you outfox the retirement office, guys. Okay. You live as long as you can, because remember what I said at the beginning, every single option is going to pay you for your whole life. Okay. Everything from life only all the way down to non-spousal, joint, and survivor will pay you, the member, a check every month for the rest of your life. Okay. Regardless of whether you have overcome your initial amount that you put in with modified cash, or if you're outside your certain period that we're going to pay a death benefit your whole life. Okay. Now, modified cash and period certain and continuous, they both have something we call beneficiary flexibility to them. Okay. And what that is the ability to change your beneficiaries after you've started to receive payments. Because maybe you have that Thanksgiving. You know the Thanksgiving I'm talking about. That Thanksgiving that makes you reach for a beneficiary change form. Now, if you want to be able to do that, change your beneficiaries after you've started receiving payments, you need to have beneficiary flexibility. Modified cash and a period certain and continuous option will give you that. Beneficiary flexibility also allows you to have multiple beneficiaries. Let's say you want your beneficiaries to be your 10 grandkids or your 3 favorite nieces and nephews. You can do that. Maybe you want an entity as your beneficiary. Some people have a very important church or charity that they want to make sure gets a little money. If you want to have an entity as your beneficiary, modified cash or period certain and continuous. Okay, there you go. The reason that I talk about beneficiary flexibility right there is because the next option that I'm going to talk to you about, which is the joint and survivor option, does not offer you any kind of flexibility with your beneficiary. Okay, you get one, and I'm not talking like one primary one, you get one beneficiary. Who do you think that one beneficiary is with the joint and survivor annuity? Well, that's right, it's your spouse. More importantly, it's the spouse that you're married to at the time you establish your effective date. And if you know, if I say it that way, it's important. With this one, how it functions is you get to pick one of these percentages, 50, 75, or 100%. And that is the percentage of your monthly amount that will be paid to your spouse upon your death for the rest of their lifetime. Okay? However, with this option, if your spouse predeceases you, meaning dies before you, you don't get to put a new beneficiary on, even if you get remarried. There is no beneficiary anymore if your spouse passes away. Now, we'll still pay you. We pay you for your whole life, like I said. There just is, that's it. There's not, when you pass away, it's done. Okay? Let's do a numbers example on this one. It's kind of easier to tell about this. Let's say that I'm the member, and I get $1,000 a month. Okay? And I have the 75% joint survivor. If I pass away, when I pass away, then my spouse would receive 75% of my monthly amount. So if I'm getting $1,000, that means they will get $750 a month for the rest of their lifetime. This is a really good way to, take care of a spouse who might be financially impoverished should you go away. Okay, it's a good idea if this is your goal. Okay, but kind of a nice way to do that. Now, with the next option that we're going to talk about, the non-spousal joint and survivor, that one functions a lot the same way. But there's only one percentage, and it's 50%. And you don't get to pick any other percentage, just 50%. But what you do get to pick on this one is who your beneficiary is. And the criteria for that one is pretty simple. It just has to be one living human being. Okay? One living human being. And the reason that I say it like that is because it can't be a trust. Okay? But numbers example, if I'm getting $1,000 a month and I pass away, then whoever I've selected as my one living human being would get 50% of that. So they would get $500 a month for the rest of their lifetime. Okay. I find this one is used a lot with people who are trying to do some special needs planning. Maybe they have an individual who is very, very dependent upon their income for survival. At the same time, I've seen it used to take care of people who might be receiving, life-giving government aid. Okay, is a good way to put that one, because we don't want a death benefit to hinder our loved ones. Okay, and sometimes we have people who are on certain programs that are very important that they be on these programs. And so we don't want to try and give them something good like a death benefit, only to have that knock them off of a program that they really need to survive. So just something to keep in mind when you're doing some of these financial plans, okay? When you're looking at your lifestyle as a whole and the things you need to take care of, okay? That's kind of how non-spousal and joint survivor work. Now, I do want to bring something up with these two options that is particularly important. Who you have as either your spouse or your one living human being, they become a factor then in the calculation of your monthly amount. Okay. So I had somebody who was talking to me about doing the non-spousal joint survivor. And essentially they were like, I think I'm going to make my one living human being my granddaughter who just turned 19. And I said, oh, yeah, you can totally do that because you can. But I want you to contemplate for just 1 second what adding the probability that we're going to have to make a monthly lifetime benefit payout to a 19-year-old is going to do to grandma's monthly amount. It's going to bring it way, way down because we're using mortality tables for that individual. Their age is taken into consideration. A lot of different factors for those. So if you have the one beneficiary that we're also going to be trying to provide a benefit for life, their age mortality tables become factors in your monthly amount calculation. Okay? I've seen them be used in great ways that really help families, but it's something you really have to consider and be aware of. Okay? Okay. So the last one we're going to talk about here is the designated period. Designated period, it is exactly what it says it is. It is for a designated period only. Now, it's important you understand the difference here. A designated period annuity, really, that's just taking an amount of money that you have and chopping it up over a period. There is no context for providing for your life because it doesn't. It has a period and it ends. Okay? There, for the designated period, you can pick 5, 10, 15, or 20 years. Okay? And those look suspiciously similar to some of the other options we have, doesn't it? Particularly the period, certain, continuous options. Okay? Now, they can be very useful tools for people. In fact, I've had people who said to me, Heather, it sounds like you don't really like these. Well, I have a reason for most of the opinions that I have about stuff. And with this one, there was, I took a call once from a lady who was talking to me about her annuity. And she said, hey, can you check on my account real quick? I didn't get a benefit payment this month and I have to go pick up my prescriptions. So I'm checking on it. And I said, okay, well, let me pull your accounts up and have a look at it. And I said, well, it looks like you came to the end of your 5-year designated period annuity. And she said, that's not the type of annuity that I have. I have that one that is 5 years, but it's for the rest of my life. No, you don't. She filled out the application incorrectly. There was no payment coming. Okay? Things like that. It's a terrible scenario for the member, but it's also hard on the person that has to tell them that. Okay? Make sure that you understand these things. It's just very important. The designated periods do look a lot like the periods certain and continuous. And most of the time when you run estimates, the designated period is going to be the much higher amount because it's simply that money chopped up over a designated period. Okay? Now, if you pick the 5-year designated period option, which some people do, that's going to be taxed at 20 and 5 because it's under a certain time limit that the IRS has for what we call periodic and non-periodic payments. Okay, so that one's taxed at 20 and 5, just so you know. I've also seen people do great planning with the designated period ones, though. Okay, in fact, I know somebody I was talking to recently who planned on taking a designated period annuity for 10 years from age 55 to 65. 65 was their full retirement age for Social Security. So they were then going to pick up Social Security at 65 and just live on that. That is a plan. It's a valid plan. I don't get to judge other people's financial plans. For me, I'd much rather run my benefit from NPERS with my benefit from Social Security in conjunction. But it depends on what kind of retirement you want. Sometimes time's more important. Okay. So we're going to look here real quick at some benefits that we've run on our estimator for you. Now, when we did this, these are just examples, okay? What I really want you to do is for you to get your own numbers, okay? But when we look at this, we use somebody who's age 65. We used what? $60,000, put it in our benefit estimator for both a defined contribution member and for a cash balance tier 1 member. And then we ran like 4 sets of different numbers, okay? We ran it for a DC no COLA annuity and a DC with COLA annuity, okay? We ran it for a cash balance no COLA annuity, and we ran it for a cash balance with COLA annuity. Remember, anything that says with COLA or COLA, that's going to go up 2.5% every year, okay? The no COLA column, that's a static number. That's going to stay the same for the life of the person, okay? We can see here by this, the table of numbers, that the life only is it's the highest one monthly, right? Yeah, it's going to be because there's no death benefit, okay? But modified cash is not far behind. Sometimes it's very close, actually. I've seen it be very close. We can see with the period certain and continuous options that as we like heighten that probability of paying a death benefit, like lengthening the amount of time we're going to do that, that affects the monthly amount. Like the 15-year, because it's a longer period of time, is a little bit less than the 5-year is, okay? Same thing goes for if we're going to pay your spouse 100% of your benefit when you pass away, or if we're going to pay them 50%. Okay. And by the way, these are member amounts. So if you want to know like what the 50% is going to be, you take that amount, 50%, half of it. Okay. Same thing for the 75. 75% of that amount is going to be what it is. Okay. So this just kind of gives you an idea of what some of this looks like. But it's simply to illustrate some of these points that I've been trying to make when we talked about the options, because you want your own of these, honestly. And what we're going to do is I think we are going to take a little break here. I'm going to give you 10 more minutes. And when we come back, I'm going to have Matt walk you through the benefit estimator, and then we'll continue on. Okay? All right.
Hey, everybody, welcome back. I hope your stretching and your caffeinated beverage securing was successful over your break. So here we go. I realize I do emphasize that every detail, everything we talk about is extremely important during this presentation. Otherwise, we wouldn't talk about it. But I realize also not everything's a competition. However, these details about the benefit estimator are the most important things that you will hear today. It's just an opportunity to give you a concrete tool. Capture those numbers, put these things together, because that's the tools that you're going to need to reach your goals in retirement that we need to do. So let's jump through this estimator with some details I want to point out, and then we'll keep rolling with the rest of the day. So first of all, these are estimates. That's hence the term estimator, not determinations of your monthly annuity amounts, but it's an important tool, and these benefits are pretty accurate, and we'll talk about one detail in a moment. The other thing I do want to mention, this is a non-secure section of our website, so you can pop on here even without going through the login information. Just jump on. When you do that, jump onto our website, that npers.ne.gov that you have memorized by now. As you jump on, you'll see that white ribbon across the top. Hover over member info when you're there. Slide down and click on that benefit estimator. And that, when you click, that brings us to this slide that shows all of the, we have to click, first of all, we have to click that disclaimer box. Please read those bullets to make sure you can in good faith click that disclaimer and understanding. After you've clicked that box, just simply click one of, the plan that you're a part of, click that link, and then that brings you to this option, or I mean, this page of many options. Go through, change termination dates, change what kind of plans you're thinking about, monthly annuity amounts. This is the time for, I mean, lack of a better term, you can kind of play a little bit and generate many different options and estimates and see which one works for you. So go ahead, go through this on one particular estimate and calculate, or click that calculate your estimate. And that brings us to this 30,000 foot view where all of these options are highlighted. The cool thing about this page, it's not really visual here, but each one of those options in that left column under benefit calculations are links. You can use that hot link to just click in, get information about that option that Heather has just taken us through. Just kind of a reminder of which is best for you to move forward in this estimate. The other detail I want to mention, and you're probably intuitive enough to see that, but our gross amounts and our net amounts are the same on that estimate slide. So once we, with that understanding, we click to that next slide, and then we see more detailed view of that estimate that we just ran. Gives you that bottom line number of how that benefit number was calculated. The reason there's that super cool black arrow pointing to the ribbon or to the printer icon is simply this is a valuable tool to keep building in your toolbox. I would invite you to print out every estimate you do and take that with you when you have conversations with either the person that you have on retainer that's your financial advisor, maybe your loved ones. Maybe you want to have these conversations with those that you're considering your beneficiaries. So thanks so much for giving me just a moment to talk about what a great tool this is. Now I'm going to hand it back to Heather, and we'll keep rolling as we look for next in retirement alcohol.
Awesome. See, we put jokes in here occasionally. Sometimes they're funny even. Thank you, Matt, for doing that. The benefit estimator, you guys, we don't want you to have any excuses not to use that, because there's only one thing that you can't do without when you're doing a financial plan, and that is just very simply numbers. Okay, you have to have numbers. So if you're sitting down to look at your retirement, and I don't care how far off your retirement is, okay, if you're making a plan that involves money or finances, sit down and get some numbers. Okay, Social Security, you do have to establish a My Social Security account, but it'll show you your 35 highest years. You can use their benefit estimator to get your numbers about exactly what Social Security is going to pay you at exactly what age. Okay, you can get onto our website and use the benefit estimator. Great question here. I'm going to answer this one verbally. If you have an account for state and for county, let's say, which you might, do you use that estimator for both? Well, yes. Tell you a little secret here. The state and county one is essentially kind of the same. Okay. There's a drop down on there for whether you're defined contribution or if you're cash balance. Okay. But essentially, remember, you're at a state county seminar. So those plans are very the same. Now, some of the other plans that we administer are very different. And this is a good one to get out of the way as well. If you're someone who is in the school plan, perhaps, or in our patrol or a judge's plan, very different plans than the state and county plans. Okay. Those are actually considered defined benefit plans, just so you know. And that's not something we've talked about, is it? We talked about defined contribution. We talked about cash balance. Defined benefit is different. Okay. So speaking of different, everybody's financial scenario is going to be different. And I don't care if you're sitting next to your spouse. I mean, their financial scenarios, situations are different. How they view money is different. How people have spending habits, different. Okay. So no two retirements are ever the same, just so you know. When you're choosing an option, something that's going to suit you and your family and your needs, there's a lot of things to think about. Some of these things, maybe you've never sat down and had a real think about. But some of the things you might want to consider, just throwing it out here, these webinars are good food for thought, okay? To get the gears moving, to get the conversations happening, okay? You have to really consider things like your mortality. I mean, essentially, your health history, your family health history. When I do my financial planning, I have to remember that, on my mom's side of the family, I've got heart disease and diabetes. On my dad's side of the family, we have cancer and dementia. Things like that will affect my plans. Okay. Um, Another thing that people might not consider is, what kind of lifestyle do you want in retirement? Some people, they are going to take that 180-day cruise around the world. They've been putting it off. They said, I'll do this in retirement. When I get there, when I have time, I'll do this. And then they start doing this. Maybe you're sick of the Nebraska weather and you're going to be a snowbird. And so, you want to establish presence someplace else. You can do that. Just make sure you have funds there to do that. Okay. Do you want to continue to be the bank of mom and dad? That's more of a thing these last couple of years than it has ever been. We take care of larger families. We take care of family members. But sometimes when you look at becoming someone who is on a fixed income, you may have to have some hard conversations about the fact that, this is my income now. This is what I've got. I can't be doing a bunch of different things. Um, Sometimes that's not the conversation. But these are the kind of conversations that we want to have with people we love. You go to that breakfast bar, that kitchen table, that coffee table, that office, wherever you do this in your house, and have a sit down and a serious talk with some of the stakeholders in your life regarding, what they think your retirement's going to be like. If you're retiring together with a spouse, what are you guys doing together? Some people have very cheap retirement plans. Other people, and I'm going to tell you, there's study after study that says in retirement, your entertainment budget explodes because now you have the time to go to the cinema with your spouse, to, hit the old melodramas. There's fun things that you can do that you've been putting off that people will actually engage in. So make sure that you have the budget there to have a great retirement, to really go do these things you want to do. There's a lot of things to consider. Okay. So there you have it. I'm going to tell you, when you sit down and consider all this stuff, some people need help. My mom always said, Heather, you don't have to learn how to cook. If you get a job that pays enough, that you can hire somebody to cook for you. Now, I'm going to tell you, I learned to cook anyway. But the same goes for a good financial planner. I mentioned this before, but I'm a pretty big advocate of people, if they're not comfortable with figuring out these decisions themselves, going to a professional. Okay. And most financial planners these days, they're going to try and get you to an 80 to 85% salary income replacement in retirement. Okay. Which means that think about what you're making now, right? They say that you can live comfortably on approximately 80 to 85% of that. Okay, makes sense, right? That's not shit. Let's go. So what we've done is try and do some kind of examples for you guys. Now we have something called the nest egg handout. It's a handout that we've done that basically lets you, we call it the pig handout, because it's got a little piggy on it, like a piggy bank. But this handout has a chart, and the chart says, okay, if you want to retire at this age and you think you're going to live to this age, and you want to maintain a lifestyle that is at this average level, you'll need this much money on top of Social Security to do that. Okay, that's essentially what that whole handout says. And there's a great chart on it. Matt has just put that into the chat. Okay, I'm going to encourage people to at least pop this up, if not now, after the seminar. Okay, but using this chart, we did a couple little salary replacement examples. So we looked at the chart and we said, okay, if we want to retire age 60 and live to age 90, and we think that we'd like to maintain a $30,000 a year lifestyle. Okay, now to do that, we're going to need $2,500 a month, right? Right. So let's say Social Security is going to help us approximately 40%. Because remember, Social Security is only ever really designed to replace 35 to 40% of our income. Okay? That's all the program was ever supposed to do. So if it does the high end, 40%, then essentially that's $1,000 a month. Okay? So we've got 1,000 of the 2,500 that we need to maintain a $30,000 a year lifestyle. Okay, so we need to find $1,500 per month. Now, according to that nest egg handout, what we're really going to need is that we would need to have saved, on top of our Social Security, $496,000. It's quite a bit. I know a couple of people that have it, but I know many, many that don't. Okay, so let's see what the plan can do in respect to that. If you're a DC member, you could spend only about $251,500 to purchase an annuity. That's with this year's rates. That would get you $1,502.72 per month. Now, that's a life-only annuity, so no death benefit, but it's got a COLA on it, so it's going to go up 2.5% as kind of your hedge against inflation. Okay, and that's paid for your lifetime. So there you go. Now, if you're cash balance tier 1, you got an annuity with COLA. It's a life only one, but this is where you can see that factor rate that we talked about. The higher it is, the less you have to spend. If your cash balance, you only had to spend $207,100 in order to get that $1,500 a month that you needed. Okay, now remember that $1,500 is what we're adding to our $1,000 a month to get $2,500 to maintain a $30,000 a year lifestyle. Okay, now I know a lot of people that when they look at this, they're not too pleased. And they say, Heather, you said you only have to spend $251,500? Well, that's because I redo this slide every single January with the new rate, okay? And last year, with that rate, it was 3.12%. So I had to tell people that if they spent $324,000 from their account, they could get that $1,500 a month. So the rate is a factor, and it does really kind of matter. Okay, so that's just to highlight that. I know nobody wants to look at that pig handout. I really do. I do. We did develop that in conjunction with an actual financial planner. We paid them to help us develop it using their software. Okay, so the bad news is on that one, the clear bad news, is the fact that that was done in 2016. Okay, The numbers on that have not gotten better. However, the fact that you have Social Security and that you have this plan to run alongside that is fairly comforting. Okay, you have things that you can set up as income streams, but do your own math on this and see what you're comfortable with. Let's talk taxes, annuity taxation. I told you when payments come to you from this account, they are taxed, right? So we know that lump sums are 20 and 5. That's pretty easy to get through your head. Annuity taxation's a little different, okay? But it's just as easy to get through your head. You ready? So you know when you got your job, right? You had to fill out a W-4. And that told your job how much taxes you wanted withheld from your paycheck, right? Well, retirement is your new job. That's your new gig. So when you fill out your retirement application, you fill out a W-4P, stands for pension, which tells us how much you'd like to have withheld from each check. So it's essentially, very much the way that it's done now, it will be done on this check, like income, okay? Now, it's important that I mention, if I haven't mentioned, I don't think I mentioned it before, that W-4N is for state taxes. And I told people if you wanted to be exempt from state taxes for whatever reason you were exempt from state taxes, you'd have to tell us that on the W-4N, okay? But what I didn't mention is the fact that we can't really look at your address to determine that. There's a lot of people who fill out a form, like a new beneficiary form, and send it in, and they're like, hey, I live in Texas now. Not that I know why you'd live there, but I mean, it's called the good life for a reason, people. But if you do live someplace else, move someplace else, maybe for better taxes. You move someplace else and you want us to stop withholding, you can't simply update your address to do that, okay? Because, I mean, there are plenty of people. Think about how so many people work remotely now, but their income is coming from an entirely different state, okay? We can't determine simply by your address that we need to stop withholding Nebraska taxes. So if you want us to do that, you have to fill out the W-4N, okay? Okay. Incidentally, if that is the case, you then need to contact the Department of Revenue in the new state that you live in to see how they are going to get taxes from whatever it is. Okay. So disability retirement. I don't go into this one too very much, mainly because it's a pretty personal thing. But I do want to let you kind of know how it is, because everybody thinks this works like disability insurance, and it's not like that. Simply, it gives somebody who has terminated or is under age 55 access to being retired. Okay. So there are a couple medical examinations you have to go through, I think, and our qualifications for this are different than Social Security's. So I know people who have qualified for Social Security disability who have not qualified for disability retirement through our office. Okay. It's important you review that. But I'm going to tell you, we have a great staff member who walks people through this process and helps get them all settled and ready to get it done. Okay. So if this is something that you need to access, you call. You have the number is in the binder on the very first slide. Okay. And if you don't have that, make sure you go back into the chat and get the binder materials. They have all our contact information in there. Or you can just go to our website, which is what, guys? It's NPERS, NPERS.ne.gov. So let's talk about the only thing that's more fun than taxes. That's right, it's death. Death before retirement. So the time period that we're talking about right now, well, essentially that's what? That's now. This is before you have retired or terminated. So before you have ceased employment. If you have a non-spousal beneficiary listed, then they have access to your account If your cash balance, they can do a lump sum or a rollover, but they have to take the entire account within 5 years. If you're DEC, they can do those two things, but they can also do a systematic withdrawal if they want. It just has to be, account cleared out in 5 years. If you have a spouse listed as your beneficiary, kind of same thing, lump sum, rollover of cash balance, and but they have 10 years now. If you're spousal, 10 years, a little bit longer. Same thing, if you're DC, they have access to that account to do a systematic withdrawal, but also clear the account in 10 years. But this is the big one, and something you might not have known. If you pass away right now, your spouse can notify us if they are the beneficiary within 180 days and have access to 100% joint and survivor annuity. Now, I didn't really understand this when I started in the training department, I'm going to tell you, because I was like, why would my spouse want a 100% joint and survivor annuity when I, the joint, am passed away? And my boss, he was very nice about it. He said, well, Heather, essentially, it's simply a lifetime annuity payment to them. It's just figured or calculated using the joint and survivor tables, okay, which is why they call it that. So there you go. Your spouse could have access to an annuity payment that would take care of them for their whole life, essentially. So you might just want to let them know, if you like them, or if you have them down as the beneficiary, that's available, okay? Death after termination or retirement. So essentially you have ceased employment. So if you still have money in your account, then death options are the same as they were on these last two, okay? If you've purchased an annuity, then the annuity option you pick is going to be how that death benefit's paid, okay? Essentially, that's it. Pretty simple, right? But things are never as simple as they seem. And that's kind of, with life, same deal. But when we talk about death, the reason that I stop and kind of go through beneficiary changes now, and we are going to talk about that in a second here, is because there are literally only two times, in my opinion, from all that I've seen, where people make the worst financial decisions. Decisions that sometimes don't make sense, or you go, are you sure? And they are, you ready for it? Number one, if you're in a crisis, and in danger, something is happening, you will make poor financial decisions. The second one, if you're in grief, if you're grieving the loss of a loved one or dealing with death, that is not the time for you to be making any kind of financial decisions. And I've seen people get not only taken advantage of, but really just wreck their finances because they're grieving. Which is why I tell everybody, when you're sitting down at that coffee table, breakfast bar, office, having these tough discussions, talk about this stuff, because the damage that can be done afterwards from poor people who don't understand, or maybe they're the spouse that's never handled bills, or things like that, when no one is prepared for a death. It's awful. Okay. The things you can do in particular are making sure your beneficiaries are updated. So let's talk about that. Okay. As a state employee, when you get on and do your open enrollment, you do beneficiaries at that point in time. Are those for your retirement account? No, they're not. Okay. Those are for your life insurance. And it's an important distinction, because there's a lot of people that think that they update their beneficiaries all the time on that, and they don't do it for us. It's not for this plan. So how do you check if you have beneficiaries? Well, we fought really, really hard to make sure that your beneficiary listing is on your statement. That one that you get quarterly, you can review that, and on page 2, your beneficiary designation should be right there. Now, if they're not, I'm going to tell you that you should pick up a beneficiary designation form and fill it out. That's just pretty simple and plain, and the best course of action on this one. Little fun fact here. Some people know this, some people don't, but it's important to know if you don't know it. A beneficiary designation on something trumps the will. So if you have a will and you think that that's going to take care of all of your death and planning needs, just to give you an example, let's say that you kind of forget about your retirement account and you leave maybe your ex-girlfriend on there as your beneficiary because you've got a will. That will is going to ensure that all of your property and the things that you need are going to go to your family. Well, I can tell you, when you pass away, we're paying that to your ex-girlfriend. Make sure that the beneficiaries on here are the people that you want. Page 2 of your statement. And if you don't, you click that link, you download the form, you get it notarized and send it back. And you're like, Heather, getting a notary is a pain, and I don't want to do that. Okay, I get it. But I'm also going to let you know that's what we call a kind of low-tech fraud deterrent. And nowadays, you have to try and protect yourself from fraud pretty much any way you can. That notarization says to us that it's you filling out this form. Okay. Most of these retirement accounts are actually quite a bit more than people even realize. And so the payouts on them, I mean, the biggest payments that leave this office, hands down, death payments. Okay. So a way to really minimize some of the damage that can be done is to have this all set up in advance. Okay. Okay. Now, you can call us and ask who your beneficiaries are, but we can't tell you over the phone who they are. That's a violation of HIPAA. So if you want, you can write in and say, hey, can I have a copy of the last beneficiary form that I, put on file with you guys? We can do that. Almost just as easy just to fill out a new one. I bet you that since the last time you filled it out, something in your life has changed. Because life changes. There's births, deaths, marriages, divorces. So many things change. It's important to keep on top of these and to update them occasionally. Okay. Also, been involved with enough attorneys that I would never do something like this where I put one person down and then told that one person they're supposed to disseminate my wealth. I don't have to tell you how many ways that can go wrong, but it almost always does. Okay. Oh, you can put a trust down as a beneficiary if you wish. That's one we usually get, a question we normally get during the webinars. Absolutely do that. If you do that, I do ask that you put maybe down the name of a trustee or a number where we, contact them, particularly if it's one of those springing or testamentary trusts that comes about due to a will. Okay. This is our beneficiary designation form. Not scary at all. If you look it up here in that plan type box in that right corner, you can see there's about 6 plans we currently administer here at NPERS. We're going to take on another one as of 2024. But if you happen to be a lucky person who is a member of more than one of our plans, you can take care of all your beneficiary needs in one place on this form. So if you put down your beneficiaries and you want to have them apply to your multiple accounts, you can do that. You just have to check the box for which plan you want this to apply to. Okay. For me, I'm a member of both state and DCP plans. So I would check state DCP and put my beneficiaries on there. I am also going to tell you this. I know you get 2 statements if you're one of those people who are in DC or cash balance, but also have a DCP account. Make sure you check page 2 of your DCP statement. There's a lot of people who might have gotten into DCP after they started contributing to their mandatory plan and think, oh, my beneficiaries from my mandatory plan, they apply to both. No, they don't. I've seen people who did literally 2-page meticulous listings of beneficiaries for their mandatory account and then gone to process payment of their DCP account and there is nothing. Okay. So If you get that statement for your DCP, check page 2 to make sure you have beneficiary listings. And if you have assumed that your mandatories just kind of gone over to the other plan, that's not true, okay? These percentage things at the back here, these are particularly important, just so you know. If you list primary beneficiaries, make sure those beneficiaries all total up to 100%, okay? 100% of your account. Also, almost all your primary beneficiaries have to be, actually, all your primary beneficiaries have to be passed away for us to move down to the contingent beneficiaries. So if you have 3 beneficiaries in your primary beneficiary box and one of them passes away, technically, we would simply pay the other 2. Okay, there you have it. But all 3 of them have to be gone before we move down to the contingent beneficiaries box. It's important to know. Okay, we're going to talk about reemployment. This is kind of a hot button issue. It always has been, mainly because it has to do with that rule, the IRS rule, okay? The IRS golden rule that says, hey, you have to cease employment in order to take funds from this retirement account, okay? And we established that, right? But the IRS gets real persnickety about it, and they say, okay, well, we're going to give you a definition of what that actually means when we say cease employment. So your termination date or your last date of work starts a clock for you. And that clock is for 120 days. Okay? Now, we all know that the big plans that we're in, let's say you're in the state plan. How many agencies are in the state plan, guys? Do you even know? It's massive. You've got DHHS, and you've got corrections and roads and revenue and us. It's so many agencies, okay? So when we talk about reemployment, we're talking about coming back to employers that are in the same plan, okay? The same thing goes for counties. We know how many counties there are, right? If you're working for Platte County, then you're contributing to the same plan as Hamilton County, and you're contributing to the same plan as Custer County, or Franklin, or Thayer, or Cherry, all in the same county plan, okay? So when I say reemployment, I am talking specifically about coming back to these plans or employers who participate in these plans. And I'm talking about doing it during that 120 days. Because if you have a termination date, your last day of work, starts your clock of 120 days. We have a lot of very loyal, dedicated employees in all of these plans, okay? But the IRS says that you cannot terminate employment, attempt to take funds from your retirement account, and then come back during those 120 days. They say that is a sham termination. They say you had no real intention of actually terminating, okay? So this is a big deal. Make sure that you are aware of those 120 days and that you do not violate this by coming back to someone who participates in this plan. Okay? Okay. Now, let's say that you terminate your employment with the state and you decide to go live your dream of being the best barista you possibly can be and dominating a Starbucks. So you go to the Starbucks. You can work there. That's private employment, totally different, and we don't care about that. But what we do care about is if you were to come back into an employer that participates in this plan. Okay? Okay, that's reemployment. I'm not going to harp too much on it, but there are some pretty major consequences if you violate this. Okay? And I'm just going to leave it at that. Mainly because what I really want to talk about is DCP, because I love talking about DCP. I told you earlier I'm not really allowed to have many opinions or connotations about plans and figures and things like that. But I'm a member of this plan, and I love talking about DCP because it makes so much sense to me that it's ridiculous that we aren't all in it. Okay? With DCP, this is a 457 plan. Okay? 457. So I told you earlier we're in a 401A in our mandatory plans. The 457 plan is a voluntary plan. It's another one of those things that is exactly what it says it is. It is deferring some of your compensation until another time, in this case, retirement. Okay? So you're deferring compensation to retirement. Anybody who's in the state, state employee can participate in this plan. We also have a lot of counties that have their own DCP plans that are administered by, local financial planners or something like that. But we do have certain counties who participate in this state plan. We call this state DCP. And those counties, are you ready for it? Dodge, Gage, Greeley, Hall, Johnson, Lincoln, McPherson, Richardson, York. Thurston County's in the process of joining. Elkhorn, Logan Valley Public Health Department, Northeast Nebraska Public Health Department, Southwest Nebraska Public Health Department. These counties also participate in the state DCP plan. So if you heard the name of the county you're employed by, hey, you participate in what I'm talking about. And if not, these rules still apply to DCP plans most of the time, okay? Particularly when I talk about contribution limits and stuff. Are you ready? I love this plan. I am a super cheerleader for this plan. I think everybody should be involved in this. You determine whether you want to be, okay? This is a plan that you can put in, compensation from your check. It's not matched. There is no employer match on this one. This is just your money. But do you remember how I talked about earlier with the cash balance members and the fact that we don't get to make our own investment decisions for that plan, right? And so most people are like, well, why don't I don't need to know about investing. I don't do it. This plan is where you can do that. If you're interested in kind of maybe a safer environment, an easier way to get involved on starting to learn about investing, DCP is the way to go. Essentially, some of the great things about this one. Now, I do have to let you know that because of what this is, you can't get your money out of it, can't access distribution options for the DCP plan until you terminate. It's the same with the mandatory plan. You can't get money out of it until you cease employment. So you can't get money out of this one until you cease employment, okay? But it's easy to become involved in. It's super easy. Oh my gosh. In fact, I'm going to clarify something here. We worked real hard to get this to be part of open enrollment for state employees. And now we have people who think that they can only access it during open enrollment. Not true. You can become involved in DCP any point in time. Okay. If you go into Workday and decide you want to start contributing, bam, you can do that. It starts first of the month following. Okay. So anytime you want to. In fact, I wholeheartedly hope people will go back to wherever office they are and talk about this with other people, because a lot of the newer individuals coming onto staff don't know it's even an option. And this is so good for young people that are starting out. Okay. It's good for me personally, because this comes automatically out of my paycheck. And let me tell you, money is the safest when I cannot access it for shopping. Okay. So this comes right out of my check. I don't even notice it's gone. Goes into this account. Okay. This is also invested for my investment strategy. Okay. Now, when you set this up in Workday, it's going to default you into a certain fund. It's going to default you into the target date fund. So it looks at what your date of birth is and it says, okay, per your date of birth, you might retire at 65 here. Okay. And that fund, it's an okay one to leave it in, because as it gets you closer to your retirement date, it rebalances to become more conservative. Okay. However, that's not my personal investment strategy. I'm trying to make up for some bad financial decisions, right? So I'd like some market returns. My strategy personally is a little bit more aggressive, but I have plenty of funds that I can access and put my money into that are way more aggressive than a simple target date fund. Okay, I know that because I've done my research and watched a couple investment videos. You can do it too. Okay, but you have access to the same 17 investment funds that DC uses. Okay. Now, we know that you can't access the funds in this account until you essentially terminate employment somehow. So, life also happens. Let's say, and I'm not saying that this has ever occurred to me, but maybe you go into Walmart to replace a tire, okay? And maybe they take a look at all 4 of your tires and they say, ma'am, I'm afraid we can't let you leave because all 4 of these tires are super bald and you need to replace them. Otherwise, you're an insurance liability. And like I said, not saying it happened to me, but it could have happened to me. At that point in time, I didn't expect to replace 4 new tires. I didn't. So maybe I had to stop my contributions to the DCP plan for a couple months. You can absolutely do that. You can stop them. You can restart your contributions. I'm going to tell you, every single time that I've been promoted in this agency, I have upped my contributions to DCP accordingly. I didn't miss that money. I didn't have that money. So kind of a good thing to know that you can do that. When you put money into the DCP, it is pre-tax, okay? So it's coming out, before taxes come out, which is important because the next thing I'm going to talk about is the contribution limits for this plan. There's a minimum on this, okay? In order to participate in DCP, you have to put in $25 a month. So if you get paid twice a month, like I do, then essentially that's $12.50 per check. Wait, pre-tax. And I'm going to tell you, I spent more than that in the Starbucks drive-thru. And this is going to something I feel is way better, way more important. But it's really not a huge amount to get your foot in the door and participate in this. And it doesn't have to be huge contributions. But speaking of, it doesn't have to be huge contributions. The limits on this plan are higher than IRA limits. IRA limits this year are around $7,000 for both like Roth and traditional IRAs, which is great. Like I said, I do enjoy those. But the contribution maximum for this plan is $22,500 this year that you can put pre-tax money away. And if you are age 50 and you qualify for the provisions for catch-up, then you can put in $30,000 pre-tax. When people are panicking during seminars, they say, Heather, I saw those salary replacement examples and now I don't know what to do. I'm 5 years away from retirement and I don't have anything saved. I'm panicking. What would you suggest? This is what I suggest. Okay. And so this is why I suggest it, because of these increased contribution limits as opposed to an IRA. Okay. And then they look at me and they go, Heather, where are we supposed to find $30,000 in the parking lot? And I say, no, I totally understand. Maybe it's here though. We have a lot of people with those huge, like grandfathered sick and vacation leave banks. And this is eligible sick vacation, back pay comp time, I think actually included in this, that you can roll over to your DCP plan. Now, in order to do that, you have to jump through some IRS hoops. And let me tell you, the weirder the rules sound, the more they are IRS rules. With this, you have to fill out a form, okay? When you fill out the form, you have to get that to your HR, and then your HR has to get that to us. And they have to do it the calendar month prior to your termination date. Okay, So if your termination date's any day in December, then that has to be through your HR and to us in our hands by the end of November. Okay? And for some people that's very easy, but most of the time you're like, why? I don't make the rules. I just get to tell you about them. So there you go. But this can be really nice that you can roll this bank over, mainly because worst case scenario, let's say that this eligible sick vacation back pay bank that's going to be paid to you, let's say you get that in a check and it hits your income and then does what? Bumps you into the next tax bracket. And then you end up losing a huge chunk of it. Okay? At least with this, it goes into your DCP plan. You know you're going to be taxed on it when you can pull it out, but that's going to happen later in retirement. So hopefully, maybe you're making less. Okay? Tips and tricks. Now, when you are able to access this, say you terminate or retire, you're going to have some options. Essentially, you have the same options as DC. So I know some people that when we do the seminars, the big ones in person, they get pretty upset because their cash balance and they can't do a systematic withdrawal. Well, you can do a systematic withdrawal from your deferred compensation plan. Okay, you can also take a lump sum distribution or do a rollover. Okay, you can defer it. This is when you can just, let set until RMD, of course. But this is the big one. Ready? If you're talking to somebody who is having that situation where they're going to have to pull money out of their retirement account, they don't want to do it. Let's say it's somebody who has terminated, so they're under the age of 55, and they're worried about the fact that once they take money from their mandatory plan, they're going to be subject to the early withdrawal tax penalty. Ask them if they have DCP, because if you have to take money out of DCP, there's no early withdrawal tax penalties on this one. That's because there's no employer match to this funds. Okay, so if they have to hit up one of these accounts, they desperately need money, this is the one that should be targeted first. Okay, and I don't like saying that, but gosh knows, I have somebody in my family that cashed out a retirement account recently, and I couldn't talk them out of it. And you know what I do for a living. So there you go. If you do want to be involved in this, you can enroll on Workday. We made it pretty easy in order to do that. But remember, you can do that at any point in time. You don't have to wait to open enrollment. And if you want to be involved, the sooner the better, in my opinion. We also have great resources on this plan on our website. That is npers.ne.gov. Okay. Let's have a discussion about health insurance. In fact, this will be the briefest discussion about health insurance that you have ever had, mainly because NPERS does not administer any kind of health insurance. Okay? So if you call me and you say, Heather, I want to talk about health insurance, you're going to get about 5 minutes of radio silence and then a very soft click. Okay? Because we don't administer any of it. However, this is a webinar about retirement. And honestly, you can't get away if you're not covered by employer health insurance from the ages of 55 to 65. You need to be covered by something else. Because, just straight talk here. I don't know anybody who gets healthier as we get older. And this includes me. So we need to make sure that we have some sort of health insurance or at least a plan about it if we're going to retire early or retire at 55. One of the things you can look into is the ACA, or the Affordable Care Act. Now, this one's had a question mark on it since it became a program, mainly because I don't talk about this one too much. because it is so highly politicized. Okay. And I don't have that conversation, just so you know. But I know current retirees that are on ACA zero premium health insurance currently. Okay. Retirees. And they really enjoy it. Okay. Is it for you? I have no idea. But if you want to have some numbers, which I encourage you to get numbers on everything, don't I? You would type into your Google search bar Nebraska Exchanges, ACA. Okay. And then, have a look at that. It's going to have you put in a couple of numbers and then it'll spit out what's available to you. Okay. I'm going to say I did find that was really pretty income contingent as far as things go. But, we're all state, county employees here. Check it out. It could be exactly what you're looking for. Now, we have the state retiree health insurance as well. And I'm going to tell you in the binder materials, right after this slide, we have the 2 pages the DAS gives us regarding state retiree health insurance. So if you want information about that program, you would need to look at those 2 pages, and there's contact information for DAS regarding those. Okay, not something we service here at the retirement office. Okay. Now, as far as county goes, counties have a lot of different options. And in fact, I've heard, several different health things that were offered to retirees on the way out from counties that were great plans that they really loved. I've had people come up to me at seminars to say, hey, my county takes care of us like this. Every county has different and varying options. Some of them don't have any options, but check with your county prior to leaving, as they may offer something in the way of retiree health insurance. Okay. All right. And with that, I am going to say that's all we have for today.
On behalf of the entire NPERS team, I want to thank you for taking the time and for making the investment needed to watch this online video of our 2023 State and County Pre-Retirement Webinar. We're going to leave the contact information slide rolling for another minute. That'll give you one last opportunity to grab our address, phone, and most importantly, website info. Again, that's npers.ne.gov. Again, thank you. We wish you the best as you move along on your journey towards a successful retirement.